Hey guys, it's May from Markets with May, and I forgot to hit the record button. So, this is part two of the five-part series I have on the complete blow up of FTX, Sam Bankman-Fried's interview at the New York Times Deal Book Conference. We are at about 15 minutes into the video, and I'm doing this per request of David, who's one of my favorite people and is always on my daily Monday through Friday show to talk about markets with me. He asked me to do this because I have a pretty extensive background in risk, having been head of risk and analytics for a lot of different hedge funds. But I'm buy side risk. This is largely speaking sell side risk. So it's a little bit different, but there's a ton of jargon and there's a lot of places where I think it would be really hard, unless you were specifically doing that role, to understand what in the world is being said. I'm going to share my screen here and we're going to watch at about 15 minutes what he has to say.
There was always a connection between Alameda and FTX, and almost, I mean, not almost, but from the very, very beginning, and then it never really stopped.
Well, I think it had been, in some ways, reducing. I mean, when you scroll back to 2019, Alameda and FTX were very connected in a number of ways. One of these was that Alameda was the primary liquidity provider on FTX. It was, 40-something% of volume. It was the backstop liquidity provider. You scroll forward.
Here's where I'm saying, this is not normal behavior for a hedge fund. Your largest customer technically should not be your backstop liquidity provider. I mean, maybe that happens with a couple of, it's just very weird. It's very weird. And especially if you're not double checking their collateral and their,
2022, it was down to 2% of volume. We had a lot of backstop liquidity providers, but it still had a big margin position on. And I was failing to pay nearly enough attention to positions and positional risk on the exchange, and to Alameda's in particular. And I also, frankly, made a mistake that I feel pretty embarrassed to have made. I mean, a lot of these are, but I substantially underestimated what the scale of the market crash could look like and what the speed of it could look like and how correlated it would be.
But just
now, this is where I feel like he said something, and I really wish Andrew Ross Sorkin's mind was going in, it wasn't in this prepared direction, because he's basically saying that he was the backstop for all risk. That's just not how an exchange or anything is structured. Usually there's a risk manager, and then there's all kinds of protocols associated with who gets to have the say and the vote. Here it actually almost is like, oh, I never had a clue. Well, then you didn't have a risk manager telling you what that was, and that's awkward. And then his comment that he underestimated the speed of the market crash. I mean, he says he's embarrassed by it, but you just finished bailing out two other firms. How are you going to underestimate it when literally you, in an earlier video elsewhere, lost, you said 70 million and then had to take it all in? You somehow don't understand the speed of a market failure in your own asset class. It's just really weird. It's just really, really strange.
just perhaps hoping against hope that this would all work out and that nobody therefore would realize what this commingling was all about?
So it's not how I viewed it. And in particular, again, most of the firms had margin positions. Most of the firms had burrows on FTX. The problem here, this was too big. I was surprised by the size of what it was.
It's assets that, look, it sounds like there were assets that may have been allowable to be loaned, but then there were assets that weren't allowable to be loaned, no?
So I'm still looking into the details of some pieces of this, but I do think that in addition to what I had seen is sort of a lot of the standard borrows here, that we scroll back to 2018 or to 2019, I guess. FTX didn't have bank accounts. It didn't have any bank accounts globally. We were trying to get them. It took us a while, took us a few years. And there are customers who wanted to wire money to FTX. And so I think in the meantime, some of them were wiring money to Alameda Research to get credited on FTX. And I think that was a substantial sum. And I think that the FTX's internal accounting did correctly, effectively try to debit Alameda for those funds, but it didn't happen in the primary account. And so it didn't happen, it created a discrepancy between the display of the account and what was really going on there. And I'm still looking into exactly how that worked mechanically. But that did make that position size substantially larger than I thought, and I think than what you would have gotten from most of the normal avenues.
If I'm understanding this correctly, this is actually every country's biggest nightmare of what happens when you allow crypto to come into your nation. So it sounds to me like he's saying there's people that are not supposed to be trading in the Bahamas, and what they're doing is they're wiring money to FTX, and then FTX is crediting them because the credit is done as a token to trade. And so essentially you're kind of going around it a little bit, and this is not a great answer. I don't know another way to say it. It's really bad. All right, let's keep going and see what else he has to say.
Used to effectively wash money into FTX that American investors, who by the way were not technically allowed to even invest on FTX, were doing so, and FTX was doing it knowingly because the know your customer rules were being flouted by using this separate vehicle.
How would that allow customers to flout the know your customer rules? Are you talking about people who are trading on FTX US, or are you talking about customers of FTX International?
International, you just said that there was money being sent to Alameda, and that Alameda was then providing credits onto FTX.
Right. But those users still had to go through the know your customer policy on FTX in order to do that. In order to use that ramp, customers still had to go through FTX's normal KYC onboarding.
So when do you think you knew there was a problem?
All right, let's pause that for a second. I don't think that actually complies with KYC. How do I even begin? So you KYC'd that person, then you allowed them to send money through to some entity, giving them then that's dicey, right? Like, that's just really weird. So essentially, just because I have an account with the Bank of America, it doesn't mean that I can send money to Bank of America London and then it magically just appears in Bank of America. I mean, this is really sketchy. I don't really know. Maybe this is right on the line for KYC, but this actually sounds like exactly why some of the countries have been so skeptical about cryptocurrency and what their exact concern is, because it does create this really weird situation that should allow someone to launder pretty darn easily. Just saying.
You think you knew there was a problem?
So, the time that I really knew there was a problem was November 6th. November 6th was, that was the date that the, tweet about FTT came out. And by late on November 6th, we were putting together all of the data, putting together all the information that obviously I should have put together way earlier, that obviously should have been part of the dashboards I was always looking at. And when we looked at that, there was a potential serious problem there. And
I just want to pause for a second. By November 6th, we were finally putting together the dashboards I should have always been looking at. You hired 1,000 people, didn't you? I mean, you had a lot of people in your organization. Not one of them was also looking at risk and also had a say in what kind of dashboards needed to be scrolled up to you. This is a very strange situation. Let's keep going.
And Alameda's position was big on FTX. It had just taken a huge hit. It had taken hits over the course of the year, but that was a particularly, large and one and very abrupt. And we're seeing a run on the bank start, and that was leading to $4 billion a day of client withdrawals. At that point, we started calling prospective, sources of financing, because I was nervous about what was going to happen there. If you rewind even a few days, I was a little bit nervous, but not on nearly the same scale. And I was thinking about, risks that were substantially less
When you say we're nervous, you were nervous the company was going to go on.
Now, I would say that in that section, one of the things that really struck me is how not jittery he is when he's repeating that. I think he's probably had to repeat that several times, and on their, all of that looks a whole lot like what you'd anticipate someone would do if they're not understanding how much gamma is in their portfolio, for lack of a better way to say it, how fast the situation might change on an attack on your portfolio. Let's keep going.
You were nervous you were going to get caught. What were you nervous about?
On November 6th or before then?
Either.
So I think before then, what I was nervous about was that basically, and this started, I would say, November 2nd or so, when there was, the Alameda balance sheet, through CoinDesk, and when I started to think a bit more about this, I was nervous that that would lead to substantial losses for Alameda, and that it would be a bit messy. I didn't think it was existential for FTX. I didn't think it was going to lead to a massive loss for FTX's customers. I was thinking of this as more like Alameda is going to be really tight on funds, and that maybe it would end up having some small impact on FTX, but not a significant one, not one that hurt customers at all. When you're talking about November 6th, late November 6th, then and especially as we bleed into November 7th and 8th, I start to become nervous that FTX is not going to be able to fill customer withdrawals. And by late November 6th, I am very nervous about that, and I'm starting to think about emergency scenarios, and I'm starting to think about things might end quite badly here. And the core metric that I'm thinking of there is, will we be able to make sure all customers are whole? And on November 5th, I was feeling quite good about that. On November 7th, I was feeling quite uneasy about that.
I want to go back in time for a moment.
Okay. As much as people have come down and suggested that that was not the sequence of events, that does sound like what would normally happen. And the way he's saying it is, so this particular part, as much as people are going to come down on him, I actually believe that that's what happened. I do believe that what should have been going on before that is very different than what was going on. And so this did result in a situation where it's the market tests firms from time to time, and either you have the money or you don't. Either you are solvent, have been doing proper risk management, or you have not. And I guess being around for a little bit longer, seeing more than one broker dealer go down with far more experience, I'm not necessarily as critical of this particular portion of what was done. In advance of that, I got maybe some different feelings, but here, let's continue onward.
When this summer, you were described oftentimes as the JP Morgan of crypto, referencing the 1907 panic that he helped prevent. And you had purchased BlockFi, were making investments in Voyager and all sorts of other things. When you were doing that at that time, how much of that was an effort to prop up the value of things like FTT, which was the token of FTX, knowing that if a company like BlockFi, which owned a ton of it, that if it collapsed, FTT would collapse, and in large part, the quote unquote collateral that you had for Alameda would collapse?
So I don't think any of the borrow lending desks, to my knowledge, owned a lot of FTT. I think a lot of them, may have been using it as collateral, or taking it as collateral. I don't think they owned it though, or were going to sell it. And I think that most of them ended up closing down effectively all of their lines with Alameda one way or another. And so at that point, I think that was close to a sunk cost. And so I wasn't viewing it as having any impact on FTT in particular. I did view it as important for the industry's health. I did view it as a thing where I wanted to try to keep the industry stable. But I don't think it had any, really large FTT specific impact.
And did it have it? You didn't think it had any impact? It would have had no impact on Alameda or FTX if, for example, BlockFi were to have failed?
I don't think it would have had large direct impact. And the reason I say that is that I believe that Alameda ended up returning the vast majority of its open, borrows of its margin positions with the borrow lending desks in the middle of this year anyway. And so at that point, there wasn't that much left to save from that. At that point, I think the bigger thing was just not wanting the industry to implode.
Let's talk about.
I'm actually okay with most of that answer, except I do think that that's crazy that he didn't then think about the impact to Alameda more specifically and then really go through all of the assets of Alameda at that point. So from a timing perspective, usually when you have a collapse, you would do a set of things on the risk management side that he just thumbed his nose at. That's very unfortunate. Let's keep going.
Collateral, because I think this entire experience has been a revelation for a lot of people about what might be collateral. And clearly you were using FTT and Solana and other tokens as collateral. And part of that required you to mark them in a specific way, a value to them.
Yep.
Do you think that you were marking them properly?
In Alameda's case, I don't think I was marking them the way I wish I had from a risk perspective. And I want to sort of differentiate here, like expected value or sort of like worth or something like that from security. And, I think that I don't have any strong statements to make about, what value they're assigned from sort of like, a upside perspective or even a median case perspective. But clearly I was not nearly cautious enough from a downside perspective, from an extreme downside perspective. And, I can tell you in my head, I was looking at a 30% down move over a few day period as a sort of like extreme tail case event that, we had seen once before. And then, what happened here was a 95% down move over the course of a year, and a 60% down move over a few day period with very little liquidity, and all happening at once in all of these coins in a correlated fashion, in which hedges didn't mean as much also because this was a specific crash on assets associated with Alameda Research rather than all assets. And so, even correlated hedges had limited use there, and a run on the bank at the same time. And all of that are things, in retrospect, I should have expected might happen in an extreme scenario because that's how markets work. And, we've seen other examples of that in history where when things get really bad, they get really bad for all of the relevant things at once in a very direct and correlated and quick way.
There is a lot of mixed up jargon, risk management, mumbo jumbo. I'm gonna unwind that just so that you can understand why I was making faces this entire time. Number one, the question had to do with you marking the collateral incorrectly. There's two ways to interpret that. There's the actual value, which he tried to wiggle his way through, which is the expected value at that particular point in time. There's only a few ways you do it. One way would be to take the midpoint. Another way would be to adjust it for the volume associated with the midpoint, et cetera. Okay. But we're talking about collateral here, which means what value are you going to give that collateral at this point in time? There would never be a time when you would run an upside scenario on collateral. It would always be discounting the collateral relative to the like increasing volatility in it. And in fact, this one's really, really simple. For anyone that has ever traded options on meme stocks, you will notice that your broker dealer requires that you, if you've got any kind of weird position, that you actually get less value for having that position, period. They're going to request and force you to hold more in collateral, even if the market value is beautiful, for lack of a better way to describe it. So we did a little bit of a wiggle on that one. The second way you can be thinking about risk management is you can take the whole entire book of Alameda and do portfolio risk management. And that, to me, or alternatively, you could take all the collateral at FTX and do some sort of portfolio risk management on the collateral itself and run up and downside scenarios associated with that. Okay, here's the thing. We're mostly talking about downside scenarios when we're talking about risk management. And you would use the scenario that makes sense for your asset class, always taking into consideration the correlation between assets. What's that all mean, mumbo jumbo? Okay, you a crypto exchange. Are you trying to tell me that you thought your correlation was low between the cryptocurrencies? That's crazy that most crypto assets have a correlation that's fairly high. That's number one. And number two, 30% vol doesn't seem to me to be the right vol. Annualized, by the way, is what we're talking about, but he might be doing a daily vol of 30%. But given that you literally just bailed out an exchange and we all watched Terra Luna go to zero, I'm very shocked that your downside analysis was 30, because quite frankly, big pension funds that have massively diversified across asset class, not a single asset class, will use a 30% downside scenario. So that is interesting to me. It sounds like he presented literally the scenario analysis that whatever licensing organization demanded of him. And because this is still new stuff, they probably only demanded a 30% scenario analysis, and that's all he got. So that's all he's talking about, versus actually caring whether or not his firm would actually lose money. That's what it sounds like to me. Maybe some of you guys will come at me in the comments, but that's where I'm at on that particular comment. I'm shocked, but it is what it is. All right. That takes us to 30 minutes. I will post this episode up, and there should be an episode following on number 3 of 5 to come. Thanks for watching this. Like, share, comment if this has been helpful to you. Love that. Always makes my day. See you next episode.